Well, welcome back to another episode of Lessons into Blessings podcast. I'm your host, Tari Thomas, and today we are rounding out the last 3 strategies to 10 ways to buy your next investment property with little to no money down. Now, we are continuing to talking about leveraging what you got to get what you want, and number 8 through 10 are sure to be fire. So make sure you leave that in the comments. We want you to make sure you stick around to at least hear number 9, because as I talk with many investors, this is still not a well-known strategy, and it's been game-changing for the investors that we deal with. So if you've been getting nuggets from this series, make sure you comment and share so someone else can get the knowledge too. Now, without further ado, let's jump into point number 8. So the number 8 way that you can jump into your next property with little to no money down is to invest in a real estate crowdfund. These are platforms that pool funds from multiple investors to finance real estate deals. And it allows investors to invest smaller amounts that would be required to purchase a property outright. So less than just doing it on your own. Now, a real estate crowdfund involves raising capital from a number of investors to finance real estate deals. And this can be done through an equity crowdfund or a debt crowdfund. An equity crowdfund is where investors essentially are providing the equity or the down payment for an investment project. So that investor buys shares of the property or the real estate project, and they receive a portion of the rental income and profits from the sale. Now, similar but different, because it's a debt crowdfund, investors are essentially lending money to the property developers or operators or owners, and they are receiving an interest payment over time. Now, whether you invest in an equity crowdfund or a debt crowdfund, your returns will also be determined upon that. An equity crowdfund can offer a higher return through rental income and capital appreciation, but the risk is a little bit higher and it may have a longer time horizon. A debt crowdfund, however, might be more predictable because you're receiving regular income through interest payments, though there may be a lower risk and typically a lower overall return. So high risk, high return, lower risk, lower return. But both of the returns in either one of these could be good for you. Now, I love to always use an example because it helps to make it clear for you guys and helps to drill it home. So I'm going to take a really simple example of like a debt crowdfund example. Now, if you were to make a $10,000 investment to a property developer and they were to give you a 10% annual interest, that means they're providing you $1,000 interest payment per year. Now, if they say that loan term is about 3 years, which means they're going to hold your 10 grand that you invest for a 3-year period, and they're going to give you $1,000 interest payment every year for 3 years. At the end of that 3 years, you will have the $3,000 that you've made in interest plus returning your $10,000 principal. So over 3 years, you've made a 30% total return on your investment. Hopefully that makes sense. Now, the advantages of a crowdfund is that you can pay a lower entry cost than, buying a property right out. You can diversify to different types of real estate projects, like we already talked about, whether commercial or residential, or multifamily, or whatever property type that you're interested in. Also, it gives you the opportunity to really do things passively, because typically with a crowdfund, it is managed by experienced real estate professionals. So the responsibility to manage these deals is not on your plate, but you definitely need to trust the crowdfund platform and the underlying operators of this particular platform. So I always am going to talk about doing your due diligence. And there is definitely things you should consider when doing a real estate crowdfund. Now, research your crowdfund platform, because you want to make sure that you're finding a reputable real estate crowdfund platform. There are multiple popular options out there, but you want to make sure that that platform has a track record of successful projects, transparent fees that you understand, and good investor reviews. Now, it's even better if you actually know an investor who's invested with this platform and they can give you their experience. But if you don't have that, then you want to look for definitely a track record of investor reviews. Now, as with anything when you're doing real estate, you should always do your due diligence. And one of the things the crowdfund platform should offer you might be called an investment summary or operating memorandum. Essentially, what that is you're just getting a summary of what the deal is projected to offer you for your investment. It should lay out interest terms or interest payments if it's a debt crowdfund, the type of returns you're going to receive, the type of hold, the time frame or the period that you're going to hold it, where the property is, the location. It should definitely give you enough information to be dangerous. And you want to be able to analyze the market conditions, the property location, the exit strategy, and the projected timeline. So all of this should be in an investment summary or operating memorandum. So you just want to be able to have all that information and do that analysis. Now, if you want help in understanding how to do this due diligence, leave a message in the chat. That's something that we can talk about at a later time in another podcast episode, and I'm more than happy to provide you with that. Now, you always want to check the minimum investment requirements because every deal will have a different minimum investment requirement. So, depending on what you want to invest, that will determine which deals you're able to invest in. In conclusion, really, real estate crowdfunding is a great pathway for individuals who really don't have a lot to invest and they just want to start getting their feet wet into real estate. It gives you the opportunity to be passive and to collect a check as long as you're conducting your due diligence. The next way to buy your next investment property with little to no money down is to leverage your 401k by rolling an old 401k plan over to a self-directed IRA. Let me tell you, this is a game changer. Not only do I use it to invest in properties in multiple different locations by directing my 401k into real estate projects, but I know several investors who are using this strategy that I work with, and they are purchasing real estate with little to no money down by using a self-directed IRA. Now, here's the thing. You have to roll an old 401k IRA from a previous employer to what we call a self-directed 401k custodian. These 401k custodians are essentially giving you the opportunity to invest in a wider range of assets compared to your traditional 401k. And this includes real estate, but a number of other types of assets as well. With a self-directed 401k custodian, you can purchase property directly through your retirement account. And you are doing it with no money out of your pocket except the fees that you pay for that self-directed account. Now, the benefits of using a self-directed 401k to purchase real estate is that you can grow your money tax deferred or tax free, right? So it's very similar to other investments you have in your 401k, your stocks and bonds. You're continuing to grow your money at which those stocks and bonds increase or decrease. But now you get to diversify it with your retirement portfolio by adding real estate to your deal. Now, a lot of people are like, well, what if I get taxed? No, this is like rolling over any other 401k. You can do it tax deferred or tax free and purchase real estate and grow it tax deferred until you're ready to pull it out for requirement. Now, this gives you, these self-directed 401k plans gives you greater control over your investment choices in your 401k. And another bonus is that you can do this with a Roth account as well. So if you've been stacking up in your Roth account and growing that Roth account, you can also roll your Roth account over to a self-directed plan and start investing with that Roth account in real estate. Man, I love this strategy so much. But you always want to have doing your due diligence, because there are always things you should consider when using a self-directed custodian. And you want to be able to do your research, because all of them are created differently. They have different fee structures and different payments, ways that they collect payments. So you just want to be able to do your research, understand their fee structure for investments, because they're not like your typical brokerages. You fund your self-directed 401k by rolling over your old 401k account to your new self-directed custodian. You do this tax-free, as we already discussed. And once you set up this self-directed 401k account, then now you have the ability to direct your 401k funds to invest in whatever real estate project that you want. Now, these proceeds will go back to your 401k account. So if you're making money from real estate and you're making money from this deal, all of that rent income, any of those interest payments, all of that is going back to your 401k account. So that's a mistake that many people don't understand. It's not directly benefiting you. You are directing your 401k to operate on your behalf, and it is growing your retirement account faster because you're diversifying it in real estate. Now, there are restricted uses, just like we talked about, is there are disqualified persons that are not able to live in the property or to benefit from the property, such as yourself, your spouse, your children. And we can detail this out, and I can give you some self-directed custodians that I've used and other people have used. So just drop a comment in the box and I can do a whole segment on this specifically. But you just want to know that there are restrictions on how and who can benefit from your particular investment. Another thing to take into account is what they call a UBIT tax, and it's unrelated business income tax that is applied when you use your 401k on leveraged real estate. That just means if you purchase or use your 401k funds to invest in a deal that is leveraged by a loan, there may be a small tax associated to it. But it's usually such a small percentage that the benefit of and the returns of that particular real estate project way far outweigh that UBIT tax. So we can talk more about that later. Just make sure you drop a comment in a note in the comments. Now, this is a strategy, like I told you about, that I've used, and so I know it will benefit you, whether you want to be active or passive. So you can invest in passive deals or you can invest in active deals as well. The number 10 way to buy your next investment property with, I'll say, little to no money down is to leverage a renovation loan using the BRRR method. Now, this is not a method you use because you're cold. This method means buy, rehab, rent, refinance, and repeat. It's a strategy used in real estate investment where you buy a property, you renovate it, you rent it out, and then you refinance it to retrieve your initial investment, and then you repeat the process. Now, you are going to have to put money in as an initial investment or an initial down payment, but you're able to receive that down payment capital back through refinancing once you've renovated the property. Now, this method is really, really good for my experienced investors because it is a little bit of a savvy technique. And here is how the method works. You are going to buy with a renovation loan. Now, what this provides you is being able to roll the rehab costs into the actual loan. So types of renovation loans is a Fannie Mae home style renovation loan, a Freddie Mac choice renovation loan, or a FHA 203k loan. Now, you may, if you want an owner occupied or you want to get an owner occupied rate down payment, you can pay as little as 3 to 5% down, or as a second home purchase, you can pay somewhere in the 10% range. If it's an investment property, it may require a higher down payment. But once again, the benefit is that you can roll the renovation into the loan. So just do your research and your due diligence so you understand the terms of that loan. Now, Once you've taken that down, they're going to give you draws to rehab the property. So the second step is to rehab or renovate that property. And the aim is to improve the property's condition higher than what the current condition is. So you really want to be able to find a distressed property that needs remodeling. That's because you want to get the property kind of somewhat of an under market value so that when you renovate it, it will be at a higher value. This is going to allow you to pull your initial investment back out of the deal. So your whole goal when you're rehabbing is to increase the property's value and potentially the rents as well if you plan on renting out the property. Now, rent is the second R in this strategy. And once you improve that property, you want to be able to rent it out to your respective tenants. Now, you can do this with your owner occupied because you're actually going to be in it and you can increase the value. But the goal is that this is an investment property. So you're most likely going to pick it up as a second home or an investment property. So you're going to rent this property out. And once you improved it, you rent it out. Now it's worth higher. Now you can do this with a multifamily 2 to 4 units. I personally recommend it. I've done it on kind of a 2 to 4 unit, using a 2 to 4 unit strategy, just because your rents are higher. And depending on who you're getting the loan through, they might be able to use that in the valuation of your property. Now, the rent collected should ideally cover all expenses, like we always talked about, by right. You want to make sure it can pay your mortgage payment, your insurance, your property, your taxes, and any maintenance costs. You always want to make sure of that so that you're not in a position where you have kind of a negative cash flow, right? So once you've done all the rehab and you've done your due diligence, you've got this property rented out to great tenants and you're making income, you want to be able to refinance this property. Now, when you're calculating the refinance, you want to make sure that once you refinance, the rents that you have will cover what the refinance cost is. Now, the new loan is ideally based on the property's increased value post rehab. So the new loan obviously is going to be a larger amount, and it will pay off the original mortgage in addition to covering your pullout of the original cost that you put into purchasing the property. Now, once you've now gotten your initial capital out of the deal, you can take that cash out from your refinance to go ahead and purchase your next distressed property. Now, the reason why I like the renovation loan is because it helps you to avoid having to put all of that money in that comes in terms of like the renovation budget out of your own pocket. Now, you could obviously do this strategy multiple different ways, but I'm trying to figure out how to get you to pull at least the least amount out of your pocket as possible. Now, if you take down this as a primary residence, you can walk into the property with a lower down payment and interest, as we talked about earlier. So some things to consider when doing a BRRRR strategy with a renovation loan. You want to do the math and make sure that you're getting rent and sales comparables in the area. Why do we want to do this? Because number one, we want to understand the true after repair value, so you know exactly how much money you can really invest in this deal to make sure that the property value is where it needs to be, because there is going to be an appraiser that comes back out when they do the refinance to really assess what that after repair value is so that they know what they can fund this deal with. So you want to be able to take that into consideration. As well, you want to be able to get the rent estimates because you want to make sure that after you refinance, the rents in the going area is going to be able to cover whatever your new mortgage payment is at your refinance rate once you pull those funds out. Another thing to consider is that you're going to have double closing costs, right? So there is going to be the closing costs for closing the first loan and then the closing costs to cover the refinance. So keep that in mind. And then also holding costs, right? So you're rehabbing this property, and while you're rehabbing this property, well, you can't have a tenant in there. So a lot of people leave out the holding costs on, just holding the property. So that might be utilities that you're paying. That might be the principal, interest, taxes, insurance that you're paying on a month-to-month basis as you hold without rent payment coming in. So you just want to calculate that into the total cost, because that could in fact affect the type of returns that you pull out of the actual property. Now, you want to also consider and talk to whoever is going to refinance you out of that particular property, because a lot of lenders will have seasoning rules. Now, the seasoning period may be a period in which they want you to hold the property, or that they require you to hold the property before they will refinance your loan. Sometimes it's 3 months, sometimes it's 6 months. It all is lender specific. So you want to be able to understand that and the rates that you will get once you refinance. Last item to consider is just possibly the difficulty in pulling cash out. Now, this is something I learned the hard way. If you choose a market where you are first on the block to renovate it, it's going to be a little bit harder, because the appraiser is going to need valid sales and rental comps in the area. So you want to choose your area wisely, where you have some rehabbed properties that you can say, hey, this is the after repair value that my property is similar to. So that's why it's really important to get those rents and sales comps up front. Now, I learned this the hard way, because I was the newest kid on the block rehabbing my fourplex, and I had to challenge the appraisal. So they essentially, when they first appraised it, it didn't pass, but then I had to actually go and find the appraisals, get rental comps from the owner of the nearby fourplex, just to be able to pull my money back out of the deal. So you don't want to make your life harder than it needs to be. So definitely make sure there's some enough valid sales comps and rental comps in your area, just so that you have that to provide to the appraiser in case you need to challenge it. Now, in closing, the BRRRR method can be a powerful strategy. I definitely recommend it for my savvier investors, because they can recycle the capital that they're using for their down payment over and over and over again. Well, guys, these are the 10 steps. Definitely check out the first 2 videos if you missed 1 through 7, and definitely subscribe if you want more tips and tricks on how to buy your next rental investment property. Until next time, stay blessed.